Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Consumers Bancorp. Before we introduce our speakers, a few points to note. Please submit your questions in the question box to the left of the slides. If you're interested in meeting with Consumers Bancorp, please click on the Schedule Meetings tab found on the platform navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Ralph Lober, President and CEO, as well as Renee Wood, CFO of Consumers Bancorp, which trades on the OTCQX Best Market under the symbol CBKM. Welcome, Ralph and Renee.
Thank you. Thank you, Cecilia. OTC Markets Group, thank you for the invitation to present today. And attendees, I thank you for your interest in Consumers Bancorp and in community banking. Now that you have seen our forward-looking statement disclosure, we can begin. Consumers Bancorp, Inc. is the single bank holding company of Consumers National Bank. Consumers National Bank is a $1.05 billion community bank serving East Central and Northeast Ohio since 1965. The bank has 21 offices in attractive and diverse markets situated between Cleveland, Wheeling, and Western Pennsylvania. Consumers has a track record of profitable growth, obtained primarily organically, but also assisted by two recent acquisitions. We have managed the risk that comes with growth, realizing a sustained run of superior asset quality metrics. The company has been included on American Banker's list of the top 200 publicly traded community banks and is an award-winning SBA lender. The bank's most recent CRA rating is satisfactory. We have 184 full-time equivalent employees, and Consumers Bancorp is listed on the OTCQX Best Markets. We have approximately 1,400 shareholders that hold slightly over 3 million shares. Our 11-member board is comprised of local community leaders who represent our geographic market areas and who bring a wide range of industry and professional experience. A director since 1987, Lori McClellan has led the board as chairman since 1998, and under her board leadership, the bank has grown from $130 million in assets to today's $1 billion mark. Serving as vice chairman, Frank Payton brings 38 years of community bank experience to board discussions. Addressing director succession issues, 4 new directors have joined the board since 2020. These professionals have significant experience in wealth management, legal, technology, and accounting. All are complementary to the existing agricultural, automotive, real estate, insurance, and banking skill sets already represented. Collectively, the board holds approximately 11% of the company's outstanding shares. And I should note that over the past several years, board retirements have moved significant shares out of the insider category. Most of these shares are still held by the ex-directors or their families. And corporate governance policies require retirement from the board at age 75. The bank is led by an experienced and stable executive management team. This team has managed significant growth, navigated through the pandemic, and integrated 2 acquisitions since 2020. The executive team, which reflects experience gained at regional and community banks of varying size, has an average and cumulative bank tenure of 12.5 and 88 years, respectively. Our shortest tenured executive will have her 6th anniversary next month. Excluding the president and CEO, executive management holds approximately 2% of the company's outstanding shares. And together, board members and executive management hold 12.73% of the shares. We believe in our mission and vision and have confidence in our future. The bank has doubled in asset size twice since 2009 and is more than 5 times larger than it was before the 2008 banking crisis and resulting Great Recession. In 2018, management and the board established a $1 billion objective that set strategies and initiatives designed to profitably double the bank to $1 billion in assets by fiscal year end 2025. The goal was not growth for growth's sake, but rather to grow into the infrastructure, staffing, technology, data security, employee development, product enhancement, and delivery channel investments that were made previously or that were deemed necessary to allow the bank to compete with our regional competitors. The $1 billion goal was met in December 2022, 30 months ahead of target. Two of the defining marks of the CBKM franchise is the breadth of the territory we cover and the diversity of the markets we serve. For those of you who may not be familiar with this part of the country, our roots, our largest branch, and our home office are in Minerva, Ohio, which is in the center of the branch markers on the map above. Minerva is 17 miles southeast of Canton, Ohio, which is home to the Pro Football Hall of Fame. Cleveland, Ohio is just north of the branch location markers, and the greater Pittsburgh region is east of the three most southern branches noted. Our branch network covers large metropolitan areas with higher C&I and CRE loan and commercial deposit opportunities, suburban communities with retail deposit and loan concentrations, and smaller rural villages and towns that provide agricultural business opportunities. The branch footprint alone is over 100 miles from the north to the southern point and 70 miles going east to west. We've methodically added locations that extend the footprint toward larger markets or filled in specific gaps in the territory, taking advantage of opportunities where larger banks de-emphasize a specific market within or adjacent to our footprint. Over the last 12 years, we have generally expanded through acquisition in the southeast and added de novo locations in the larger markets to the north and west. I note that while we have a large branch network, several relationship managers are responsible for multiple locations, and a few branches have responsibility for daily back office support and customer service functions. In the 5 counties in which Consumers operates, the bank holds 2.93% of the $30.2 billion total deposit market, and we consider this a $29 billion opportunity. Consumers is the largest of 2 banks headquartered in the 5 counties. And in the 12 months ended June 2022, Consumers grew organic deposits by 8.2%, more than 3 times the rate of deposit growth in the 5 counties combined. Considering the county map to the right, our branches are in the dark blue. However, we actively solicit business from the light blue shaded counties. This expanded territory includes all or parts of 7 separate MSAs: Canton-Massillon, Akron, Cleveland-Elyria, Youngstown-Warren-Boardman, Weirton-Steubenville, Wheeling, and Pittsburgh. In January 2020, we completed the whole bank acquisition of People's National Bank of Mount Pleasant, a $75 million asset bank that serves southern Jefferson County markets. Deposits in these 3 locations have increased 32% since the acquisition. In July of 2021, we completed the acquisition of 2 branch locations in southern Columbiana County from CF Bank, which filled a gap in our service area and provided more access to western Pennsylvania and northern West Virginia. This acquisition included approximately $100 million in deposits and $50 million in assets. We have added commercial and mortgage coverage, increased commercial deposit sales efforts, and added consumer lending products in the market. We recently opened the Boardman Loan Center to serve Youngstown Warren Boardman MSA, and next week we will relocate the Wellsville office to a full-service facility, taking over a recently vacated regional bank branch that reported over $63 million in deposits as of June 2022. Subject to regulatory approval in calendar 2024, we are planning to establish a branch in Massillon, Ohio, which is in western Stark County. Deposits in the 3 zip codes that include portions of Massillon exceed $1.1 billion. The total population is over 75,000, and there are 32,500 households and 6,500 businesses in these 3 zip codes. Commercial lending and deposits have been the main driver of the bank's growth. The commercial division has 11 in-market business bankers, 1 dedicated agricultural lender, and 3 commercial deposit specialists. The bank's legal and in-house lending limits are $13.3 million and $11.3 million, respectively. Our mortgage services division offers a diverse product set through 6 in-market mortgage originators. The division's back office has been scaled back with a decrease in production, but in prior years has originated over $100 million for both the bank's portfolio and secondary market investors. Our consumer loan division originates over $50 million through the branch network and through local dealerships. Concentrating on top-tier credit quality metrics, the weighted average credit score on the indirect automobile portfolio this fiscal year is 762, and the weighted average loan value is 87%. As of March 31st, 2023, 93% of the loan balances are geocoded as Ohio originations, and an additional 3% of outstanding balances are geocoded as Pennsylvania or West Virginia. Geocoding follows the real estate collateral, or if not real estate secured, the borrower. 92% of calendar 2022 loan production was associated with Ohio real estate, or if non-real estate secured, Ohio borrowers. 76% of the total portfolio was secured by real estate, and, and 1 to 4 family residential balances represent 21% of the total portfolio, of which 81% are secured by first mortgages. Agricultural related balances represent approximately 13% of the portfolio, of which 89% are secured by real estate. And owner-occupied CRE, which in this case includes multifamily, represent over 60% of the commercial real estate portfolio. The 93 million non-owner occupied commercial real estate portfolio is diversified over many property types and borrowers. Office and hotel exposure. Time prohibits a deep dive into the industry diversification, but it is safe to say that our portfolio reflects a cross-section of the businesses and industries in our region. Our top 5 industry segments are rental and leasing, which is broken down separately on the next chart, manufacturing, agriculture, construction, and healthcare. It is worth noting that although we operate in Ohio's Marcellus and Utica shale regions, we have very little direct credit exposure to oil and gas producers. Exposure in this area is limited to smaller companies that provide services like trucking, rigging, and excavation drillers. This slide provides more detail on our lending to the broad rental and leasing industry. This exposure is spread over 467 facilities with an average exposure of $400,000. Residential rental, including multifamily leasing, makes up nearly 50% of the exposure in the industry segment. Fiscal year-to-date portfolio growth is balanced, with 35% of the growth in the commercial and commercial real estate portfolios, 37% in housing-related lending, and 27% in consumer balances. Through March, fiscal year-to-date production has held up through the rising rate environment. Annualized production is within 95% of fiscal 2022, with nearly all the decline attributed to the residential mortgage business line. Total production has increased from $89 million in fiscal 2017 to $300 million in fiscal 2022. We have scaled the infrastructure to process and service over $300 million in annual production. I should note that our ability to recruit high-level business bankers and commercial credit staff from larger community and regional banks has enhanced our capabilities and access to larger, more complex credits. It disappeared. Total annual balances increased $78 million, or an annualized 17% for the 9 months ended March 31st, 2023, beating the compounded annual growth rate over the past 6 years. Excluding PPP, core loan balances have doubled since 2017. As Renee will discuss, this strong and consistent growth has been achieved and managed without sacrificing credit quality.
Thank you, Ralph, and thank you for joining us today. The next few slides show the results of our strong credit culture. Net charge-offs have consistently been below our peers and have averaged $74,000 per year from the beginning of fiscal year 2018. The large recovery in 2019 was from a full recovery of a charge-off that occurred in a prior period. The non-performing asset ratio is 32 basis points below our peer group as of March 31st, 2023. We have had a successful history of identifying potential weaknesses in the portfolio and assisting borrowers to help mitigate losses. The delinquent loans have consistently been below our peer group as well. The long period of strong credit metrics and portfolio management is in conjunction with significant loan growth. In June 2022, we moved to a new peer group of all commercial banks with assets between $1 billion and $3 billion. Following our acquisition of the 2 CF Bank branches, the securities portfolio increased and represented approximately 29% of total assets as of March 31st, 2023. The portfolio is very conservative from a credit perspective, with 61% of the portfolio invested in U.S. government-issued or sponsored securities, and 34% of the portfolio is invested in municipal securities. Approximately 92% of the municipal securities are A or better rated by Moody's and S&P, and the securities in the held-to-maturity portfolio are more illiquid, locally issued bonds. The securities portfolio has a yield of 2.56% and effective duration of 5.07. Based on current market rates, the cash flow from the portfolio over the next 12 months is expected to be $28.3 million, and we expect to redeploy much of this cash flow into loans at higher yields. In December 2022, we reached the milestone of $1 billion in total assets, which is more than double our total assets as of June 30, 2018. This growth has been fueled by a 17.7% compounded annual growth rate in deposits and a 17.5% compounded annual growth rate in loans since fiscal year 2018. The bank's deposit and funding sources are stable and well diversified. Approximately 41% of our funding is from consumer transaction and savings accounts, and 29% is from commercial transactions, savings, and repurchase agreements from local businesses. During a period of tightening liquidity, our deposits have increased by $49 million or 5% from December 2022 to March 2023. Net of collateralized deposits, uninsured deposits are approximately 20% of total deposits. This compares with an industry average of 35 to 45%. Also, we are actively working with larger depositors to collateralize or utilize reciprocal deposits in order to give these depositors peace of mind and provide us with stability in our funding. The bank has diverse sources of liquidity with total available liquidity of $360 million through the Federal Home Loan Bank of Cincinnati, the Federal Reserve discount window, CD listing services, or broker deposits. Checking and savings deposits represent about 80% of total deposits. This strong core deposit base is a direct result of the branch network and the long-term customer relationships our employees have established. Since 2017, commercial loans, which is the green line on this graph, increased by $237 million or 104%, and commercial deposits, the blue line, increased by $224.6 million or 148%. It is our strategy for commercial deposit growth to keep pace with the growth in commercial loans. The growth in commercial deposits has leveled off as PPP funds have been spent and customers have paid down lines of credit as short-term rates have increased. This growth in commercial deposits is a direct result of our commercial business banking officers and commercial deposit specialists diligently asking for and following up on obtaining the full banking relationship. Core earnings, which are defined as net income excluding interest and fees earned from PPP loans, have increased by 24.7% since fiscal year 2017. Net income increased by 22.7% for the 9-month period ended March 31st, 2023, compared with the same period last year with the exclusion of the PPP revenue earned during that period in fiscal year 2022. The increase in net income has primarily been driven by an increase in net interest income resulting from the growth in the balance sheet by successfully redeploying funds received from PPP forgiveness back into loans. In addition, increases in non-interest income, along with a focus on cost control through more use of technology and contract negotiations, has contributed to the growth in earnings. The balance sheet growth has improved the overall cost structure of the organization in relation to average assets. The slight decline in net income in fiscal year 2020 was from merger expenses and additional provision expense as a result of the uncertainty in the economy because of the pandemic. The increase in net income has resulted in consistent increases in our earnings per share when adjusted for the earnings from the PPP loans. Dividends per share increased 42% since fiscal year 2017, and based on a $16.50 share price, the current dividend yield is 4.12%. ROA and ROE continue to be positively impacted by the growth in net income. In fiscal year 2020, the return on equity was affected by the previously mentioned merger expenses and additional loan loss provision expense because of the pandemic, and fiscal year 2023 has been affected by the decline in capital associated with the mark-to-market for the securities portfolio. I will now turn it back over to Ralph, who will discuss our stock performance.
Thank you, Renee. CBKM outperformed similarly sized Ohio and Pennsylvania banks in key profitability, efficiency, and asset quality metrics. 5 basis points in ROAA, 23 basis points in margin, 350 basis points in efficiency, and 26 basis points in non-performing assets are significant positive CBKM to peer variances. This strong performance is not reflected in the stock valuation, as price to earnings and price to tangible book multiples lag the same peers. As such, we believe that CBKM is significantly undervalued. 8 times last 12-month earnings would equate to a 28.08 share price. 102.9 price to book equates to a 18.72 share price, while 86.9 price to adjusted book equates to a 23.35 value. At the current price, CBKM's discount to these three metrics based on the peer group above are 43%, 15%, and 32% respectively. This is a quick reference to CBKM's decline in relation to NASDAQ Bank Index. While CBKM's value multiples are below peer, its price decline over the last 17 months has not been as severe as the larger NASDAQ Bank issues. From January of 2022 through May 19th, the NASDAQ Bank Index has witnessed a 45% decline, while CBKM has declined 25% over the same period. In summary, CBKM is a growing institution with strong management that serves diverse markets across 21 Northeast Ohio, Pennsylvania, and West Virginia counties. We originate and manage a diversified loan portfolio, have a diversified funding base, and outperform our peer banks in earnings, efficiency, and asset quality. We believe that the company's growth, performance, and market are not reflected in CBKM's current valuation. If we do not get to your questions today, we will reach out directly. We are also accepting one-on-one calls today and tomorrow. If you register through the platform, your confirmation will indicate a meeting with Emily Bryant, who is our executive assistant. The meeting will be with me and Renee. Also, please feel free to reach out to either Renee or myself at any time. Our contact information is provided in the handouts. Thank you.
Okay, Ralph, we do have a few questions that have come in. What is your current thought process on CD specials, FHLB advances, and brokered CDs to fund loan growth? Are you trying to extend deposit maturities?
Do you want to take that one, Renee?
We do have our CD special short. We do reactive pricing, to if we need to match rates, but we have shortened up our deposit specials and are anticipating that rates may start to fall in the near term.
To add to that, our stated rate or our board rates are lower than our major competitor, which would be Huntington National. We will react, like Renee said, we'll react to on a case by case basis to match those rates or come closer to those rates when needed. But our sticker rate is less right now, and again, we have shortened over the last 2 or 3 months. We've shortened our CD specials.
Okay, the next question. Businesses have cited lending conditions are tightening, and some banks have said they are tightening lending standards. Since you have nearly maintained loan production in Q1, have you seen new clients that weren't able to obtain financing from their normal banks? Also, have you had to tighten lending standards recently?
We are not writing credits for those who cannot get credit from their existing bank. We have added commercial bankers, business bankers who have been able to recruit top tier credits from their previous banks. That's one of the reasons why we've been able to hold our production. Our commercial production is about the same as it had been in the past fiscal year. Most of the slowdown in mortgage was picked up by a consumer. But on the commercial side, we've always been a credit bank. There's comments in the market that, quote, you have to walk on water to get a loan from consumers, and we like that approach or that thought in the market. So we've always been credit oriented, which is why our long term, our delinquencies and our charge-offs and non-performing assets are all well below peer. So no, we're not. We are tightening now, and we have been probably for the last 6 months or to a year. But no, we are not writing credit for those who cannot get credit at another bank.
Okay. The next question, do you attribute any of the gain in deposits in Q1 to customers feeling more comfortable at your bank over some of the regional banks in your market that were more caught up in some of the regional banking issues that started in March? I would attribute a lot of our deposit gain was we were quicker to raise rates when rates started to increase in the fall, where a lot of banks were taking the approach that they were going to let their deposits run off. And, once they kind of started running off, they weren't able to stop it. And we were just kind of more aggressive in reaching out to clients and trying to gain their deposits. I don't know if you have anything to add to that, Ralph.
And in the first quarter, since the very first week of March, again, we reached out to our customers. We have a larger, broader base of customers than some of the banks that ran into some troubles, which helped. But our largest group of customers, we did not lose any of them after the crisis started. So, and yes, we did pick up some money from some of the regionals. The people wanted to spread their money around, but it basically, and it's the relationships we have with these customers over a long period of time that they were very comfortable with us. So some of them made phone calls. Very, very few of them made phone calls in relation to the 40,000 accounts that we have. We talked to them on a one-on-one basis. Myself, Renee, our retail executive, our senior loan officer, and they were comfortable.
Okay, Ralph, we're about out of time. So as you said, we are accepting one-on-one meetings if anyone's interested. And certainly thank you for joining us today.
Thank you very much. We appreciate it.